What is one trading principle you believe the most other educators/traders would disagree with?
Probably right now is going to be smart money traps. A run of liquidity doesn't mean inducements. There is an overlap where every single run of liquidity is a big circle, and inside there is a smaller circle of inducements.
Yes.
So every single inducement is a run of liquidity, but not every run of liquidity is an inducement. I got there in the end.
Nice.
So you have to understand what is the difference between a inducement and what is just seeming like a run of liquidity, because they are not the same. And right now, and the reason people believe in runs of liquidity is because they'll be trading 10 of them, let's say, and they'll see 4 of them play out. And they'll be like, okay, so there is hope in this because I can see it. It literally went to the pip, to the run of liquidity, mitigated it to that order block, and then dropped. So this works because I have hundreds of examples. But you got to realize is those ones that you found were working were more likely inducements, and those other hundreds of losses that you've also taken were more likely just runs of liquidity that you didn't understand, or false runs of liquidity. So to really qualify that, you have to understand how to differentiate through time, through context, through intent, and then clearly understand what is the sign of a price action signature. So a build-up of liquidity or equal highs, whether that's a channel of a trend line or a resistance level, and then price sweeping up and then going down, and you're looking for sell because you saw that run of liquidity. What if that is just a build-up or a channel of consolidation, a reaccumulation, and then you had a bullish expansion, and now the market is ready to keep going bullish? The price action signature would be identical in both. So you got to understand, one is going to go up because it was reaccumulation to go bullish. Another one was a consolidation to then run liquidity and go lower. So opposite roadmaps, you have a same inflection point. At that single moment in the market, there will be an overlap and it will completely end with different outcomes. So you got to understand, okay, how do you understand how to qualify an inducement? So certain things, just to give it away a bit, time of day. If you found a London Open or a New York key window, more likely to be inducement, heavily statistically favorable. If you have an inducement that you found in the middle of a London session, late in New York session, Asia range, is more unlikely. So avoid that. It's very easy to do. Another one is if you have a sweep of liquidity, what are you sweeping? If it's just a local buildup, low probability. If you're taking a 4-hour supply zone, increased probability significantly. And there are certain points that are more probable. Let's say a high and low of previous day, high and low of previous week are great. Asia high and Asia low is not enough. You need more. So understanding what is relevant liquidity that is more favorable just statistically. You don't even have to know the wisdom behind it. Another thing is the reaction type. So if you are getting you have to understand what is a momentum reaction, the kind of imbalances you may see afterwards. The invalidation, so a simple one is just did it break structure or not. These are all going to be nice. But then a smart money trap is that really gray area in between where disqualifying very non-contextual random patterns that just look like runs of liquidity. Let's say in the middle of Asia range and no man's land with no context, very easy to avoid those losses. And then the ones that are inducements are very easy to understand and decipher when you have the rules in place. But the smart money trap in the middle, it's a bit tough. And at times I will also be victim to a smart money trap. Smart money traps is not a buzzword. It's not something that it's apparent. I've documented hundreds of examples with a track record. I've given public trades live ahead of time. Majority of them have been with smart money traps I'm trading against. So this is totally real. And just go look around in the market. I used to trade smart money concepts, by the way. So 5 years ago, these same zones that I was believing in and trading and making profit on, those same ones are not working anymore. The market is evolving, and it's affirmed by me going to this quant event and speaking to the brightest minds in finance and them saying the market is going to keep accelerating and changing at a faster rate because of AI. We cannot just believe that because it worked 10 years ago, it's going to work today. It's a false belief. A smart money trap is basically the similar signature of an inducement, but out of context or illogical, because people's behavior will be on the pattern. So if you have an Asia low zone and that Asia low zone has that same build up of equal lows and then a run down and then channeling out towards Frankfurt Open, that channel out towards Frankfurt Open is to entice in buyers. And then as price comes down during London session, we're now enticing in sellers. And then when you come to that zone of the order block of that smart money zone, if you have a demand area right below, it's more likely to tap into the smart money zone, give a false reaction to get people in, and then go to the demand area, take Asia low liquidity, smart money trap liquidity, come to its objective, and then do the bullish move. So context here matters. The best context I can give to avoid smart money trap, write it down because it will definitely change your trading, is don't take smart money signature zones that are Asia high and Asia low. Don't take smart money signature zones that are a higher high or a lower low on structure. Don't take smart money signature zones on a Frankfurt Open. Don't take smart money signature zones that don't have a break of structure. These four would be the best way to differentiate a smart money trap versus a valid inducement sweep zone.